And with any type of investment, not just life insurance, not just with securities, but any type of investment, right? In anything we do in life, whether it's financial, whether it's in, self development, we have to have a investment objective, right? And then we have to see if these objectives are even suitable, if they're even realistic to do, right? So that's what I love what you and Jeffrey saying. It's like, well, we first have to do like a financial physical on people to see, okay, what's your income, what's your debt, what's your marriage status, what's this XYZ, to even see if these things are suitable, so that we don't just get ahead of ourselves and start these type of plans or investments, and then later on say, well, I really can't afford to have that, so I got to dip back into it, right? So that defeats the whole purpose of even setting up these plans and things like that. So that's the first thing, we have to figure out the investment objectives and see if they're even suitable for to put to give to our clients or whatever. So that's why I think it's like, it's no real, like, to me, it just varies. Like, you can either have term on investor rest or permanent life insurance. It all depends on the person's situation. You know what I mean? At least as far as as far as my belief is, and you guys could like let me know if I'm right or wrong. And then sometimes I see people say, "All right, let's be realistic, guys. Like, out of 10 people, right? And you say, all right, you buy term and investor rest. How many people even know how to invest? And invest in what? Right? How many people, like you said, how many people know the interest rate they're getting on their credit cards, right? How many people know the tax code? How many people know what a stock is? How many people know there's different types of stocks? How many people know there's voting rights with certain stocks? How many people know they're entitled to a dividend with it? Or like, how many people actually understand or are financially literate enough to know investing, right? So that's the first step. It's like, out of 10 people you meet every day, how many of them actually know how to invest and actually utilize it, right? So we have to think about that. And then when we say, all right, the whole life, um, it's kind of like they don't understand. The thing about it is too, it's like when they say, like, the infinite banking concept. If we could just simply understand that, hey, how does a bank make money? It loans out its products, which is its money, and it collects an interest rate on it, right? Most people don't know the interest rates they're getting on their savings account, right? Or checking. I mean, checking account, you're using that daily use, but savings account, you should know the interest rate you're getting on that, right? So first of all, a lot of people don't even know the interest rate they're getting with that, which is like little to none at your commercial bank, and then they're not even calculating inflation into that, right? So when you tell them, hey, with this whole life insurance policy or the permanent life insurance policy, you guys could then become your own banker. Of course, this is a long-term thing, right? It's not an overnight get-rich-quick scheme. That's not what it is at all. But you're securing yourself. You're securing yourself by saying, hey, I have this policy which guarantees me this death benefit, right, according to my health and whatever actuaries do all these numbers, right? But if I live a healthy lifestyle, I'll get, a decent price for whatever, different companies have different products, and, it's all about the design. Like we said, it's a tailor-made suit. So you can say, hey, I could build you this tailor-made suit that'll insure you with this X amount of money tax-free. It'll build this cash value. And if you do it with a participating mutual life insurance company, you'll be entitled to dividends. Now, us as agents, right, we can't guarantee dividends, but they have a long track history since like the 1800s of paying dividends, right? So it's kind of like an unspoken thing. So it's like the beauty to me in it is like, hey, I could essentially become the own banker. Now, I might not be able to cut out the other banks right now in life, but like, say in the next 5 or 10 or 20 years, right? Say I happen to live that long, then when I have to fund a project, I have my own cash value. I could take from that and do whatever I please with. And I think some of the people get misconstrued when they say, well, I mean, the insurance company, you got to pay them back when you take out a loan. Yes, I mean, but look at the money you're losing when you're just saving it in that commercial bank. You don't even calculate that. Like, let's compare it. Like, so it's kind of like, yes. And what you don't, what a lot of people don't realize is that you're paying yourself back. You're not just paying that back to the insurance company. Yes, they have an expense, right? When they're investing your money, but you're essentially paying yourself back. It's not going into some outside bank and it's like going forever. And they're doing this every day, right? So it's just all about what I really feel like. It's about educating, right? And when we give people the proper education on what these products are and exactly how they work and how flexible they are, and how we can apply these products to ensure our lives and pass on generational wealth, right? And we can combine these products because we can have term, right? Cool. We can have the permanent life insurance policy. Cool. We can have the IUL, right? There's no limitation to this, right? The same way we can have multiple bank accounts where they're giving us these really, really low rates. Like, we can do the same thing for ourselves, you know? And so that's just a little bit about what I wanted to speak on today. I won't go into details because I'm sitting back and I'm taking today to learn from you guys. You know what I mean? So I love to converse with you guys and just sit back and learn. But that's just my take on it. Like, these products are really beautiful because I think that, like, I hate to see people where they say, hey, you know what, Euro, I have car insurance, but I don't have insurance in my life. And if someone passes away in their family, then it's like they do the GoFundMe to bury their family. And it's like, hey, for like X amount of dollars a month, if you set it up the right way, all of those costs are already covered. Or you can have, you have people with children, you have a child and then you don't have life insurance on that child, and then when they're 18, you kick them out the home and say, well, figure it out on your own. You were supposed to take that life insurance policy when that child was a baby, start building that up so you could actually give them something if you did want to kick them out of your home. Because age is just a number. So a lot of us are not even financially literate enough to know these things, So it starts with the education. So I love what you guys are doing. I just wanted to come up to the stage and say it's always an honor to listen to you, Shateka and Jeffrey. And I know you guys, you have very, very good intentions when you're teaching. So I'm going to sit back and I'm going to just continue to listen and learn. So my name is Euro and I'm done speaking.
Thank you, Euro, and congratulations on the exam and passing that. I know I said that before, but definitely wanted to congratulate you on that. And thank you for all you always bring to the stage. You always bring good content. And so Moises, Chante, Miki, John, the bomb. Awesome. Definitely want to hear from you. If you can introduce yourselves and we'll go right into it.
Hey, Shateka. Hey, Jeffrey. I just wanted to say good morning. I saw you ping me in, or I saw you were kind of talking a little bit this morning, and wanted to just jump on and say hello before my next meeting coming up. And just to kind of piggyback on what Euro was saying, I think it all just does begin with that education. I think, Shateka, you and I have spoken in depth already about how I feel about life insurance and how it can be used as a financial tool. And Jeffrey, I think I've seen you a few times as well on these clubhouse events, and I just love the fact that people are talking more about it and really wanting to understand what it is all about, and us as advisors, really even sometimes bigger, what it is not, and how it can attribute and be a benefit to all the other things you guys got going on in your life. So it's not like we're talking about here and saying stop doing what you're doing, but just kind of consider what it is that you're doing, why they're offering those things, and if there is something else that's better out there for me, given the time horizon that I have, given the risk averseness that I may or may not have, is there something else out there that can kind of get me to my same goals without maybe so much of that initial risk that we all love playing with when it comes to some of these investments. And yeah, that's what I'm all about as well. I just wanted to jump on, say hello, and let you all know, Shateka, I think I was telling you that I was in the process of building out my site. I'm really excited. I'm almost done with that. I would definitely encourage all you guys, if you can follow me at The Whole Life Guy. I'm going to be putting out a lot of more knowledge and information about these things because that's really where it all starts, right? It all starts about adding value, adding some of that education, helping folks understand that there is other ways to get that financial security, and facilitating it and empowering it is definitely the next, set of obstacles. But first of all, is an education. So yeah, again, I appreciate you guys for having on, inviting me. I'm going to bounce off just to kind of listen to you guys for a little bit more, and then I do have that 11 o'clock, but I did just want to say hello, and that if y'all just want to get some more information and just want to follow some good updated news when it comes to just whole life insurance, IULs as well, there's a time and place for all these things. So I appreciate you guys. Thank you, Shateka.
Absolutely. And you and you're both are talking about that, a little bit about that term and the whole life and the differences. Let me just say that real quickly, because I know we have some people come in the room, or I guess left. But when they come back, hi, Christina down there from last night. Good discussion that you helped us facilitate. And basically, just want to talk about, you talk about, people don't know how to invest the rest. And that is absolutely true. And I always say that, why don't people allow the insurance carriers to do what they do best, right? So that's what banks do. Banks are looking at insurance carriers. All these companies out here are looking at the insurance carriers to help them. You got policies out here that's making 20-something%. I was just saying earlier on Instagram on Hustle Financial Solutions page how, most people, if they have money sitting in the bank, their money is losing value, right? It's missed opportunity. There's an opportunity cost for just having your money sitting in a bank and not inside some type of policy or some type of investment vehicle. You have policies doing upwards of 27% per year, right? Like last year we had an IUL that did 27%, and there's other types of vehicles out there. And so we have to figure a way to really make our money work for us, or else we'll be working for money all the days of our lives, as Warren Buffett always says. So we got to figure that out, right? So if you don't do that, you'll never be able to retire. Like this, 3 to 7% of people that never are able to retire, right? So I'm gonna pass it on to Shantae. You can go ahead and speak and let us know your value and who you are, and definitely introduce yourself.
Good morning, good morning, good morning. I'm over here in the California time. But I want to thank you so much for having me, Shateka, Jeffrey, and Euro. Thank you for always pinging me into the money rooms. I appreciate being here. I'm just a serial entrepreneur. I do a lot of things. A lot of people call me a polymath. I've studied money since I was a young kid. My first order of business was when I was 11. I studied Dave Ramsey, and I actually know a little bit about everything because of Dave Ramsey. I've studied him for years. For years, I would go to the library at 14 and just get his audios and study all of his things. And I know he's against whole life insurance policies, but as I grew up and learned about insurance and how you can make money, I believe, even in listening to Dave Ramsey, that you should have a little bit of everything. Like he might not believe in the Bitcoin, but I started investing in Bitcoin in 2017, and I totally forgot about it. My money's just sitting over there, So I don't, but I do a little bit of everything. I own a trucking company. I own the Classic Manhattan. Been driving trucks for quite some time. But I'm a master barber. I have a lot of talents. My next project coming up is I'll be teaching a class at Bronner Brothers in August called Make Your Beards Behave, which is totally like two different ends of the spectrums of careers, driving trucks, logistics, and air. But I do a plethora of things, and so I'm just always honored to be in the money rooms. Thank you so much for having me, and I just love learning and being in the money rooms. Thank you for having me.
So thank you for being here, and definitely understand you being on the West Coast over there with Jeffrey. So appreciate you being in here early. Miki.
Hi, good morning. Just like to show support to your rooms and offer any advice. I've worked extensively with financial and estate planning, so definitely insurance products work, especially if you put them under the wrapper of a trust and get down to transferring to the next generation. So just happy to listen in and chime in occasionally, but love that you have these rooms. These are great topics that people need to know about. Thank you.
Absolutely. Thank you for being in the room. Thank you for joining the discussion and the stage. John the Bomb.
Hey, good morning. If you PTR, actually, Euro and Shantae, Euro already has a book, but Shantae, I just sent it out this morning. Took the baby out to the post office and mailed out about 7 new books. But if you PTR, that is the book I promote on this clubhouse. Obviously, being a professional in the business and personal finance space, from business lending to personal finance. Own a company called Go for CEO, and a YouTube channel that educates on small business owners. So I love what you do, Shateka. It sounds like you have a passion for small and medium-sized business owners, and unfortunately, a lot of times a small business owner, all they do is their business, right? Is reinvest in their business, and sometimes don't see outside the forest from the trees to be able to use tools. But one thing I always like to start with, John the Bomb, is BOMB, building others means business. So what does that actually mean then, even if the topic that we're talking about here, if you take tax now, tax later, tax advantage. Tax now, everyone, and this, I think Miss Miki said, there should be 1,000 people in this room. Unfortunately, there's only a few. I've been pinging people in, trying to see, because education is key. So I'll give you an example of one of them, right? Tax Now, Tax Later, Tax Advantage. I know you guys have been talking about insurance and using some of those tools. Tax Now is checking, savings, CDs, stocks, and mutual funds. Bottom line, you will be taxed now. You make some money, you get taxed, right? You ever get that joy of making over $10 at a bank and they send you an IRS 1099-I? It's like wondering, like, oh, wow, I made $10 at the bank and they're sending me an interest taxation, right? Then tax later, 401k, I heard 403b, I've heard some of those areas, IRAs, SEP IRAs, annuities, pensions. That's tax later. But tax advantage, which is what you guys, when I got pinged in the room here, Roth IRA for sure. But then some people make too much money, and then maybe you backdoor Roth. That's fine too. That's a good strategy. But there's some complexity to that. Then there's muni bonds, municipal bonds, right? Tax-free on the federal level. Health savings accounts, right? If you have a health savings account and you can put money into something that your company offers a HSA, or you get something on your own, if you own your own business, you can put money into that and just spend money freely as it grows and make an interest on your money, and when it's dedicated towards certain things of medical. Then obviously life insurance and long-term care benefits, there's some tax advantages in that as well. So I won't chime in on the rest of them as far as how the complexity of those things, but I will say this. The one challenge in our industry is this. There's two types of advisors. One of them is a asset accumulation advisor, AUM advisor. And all they really care about is accumulating assets and managing those assets for you for maybe 0.5%, 1%, 1.2, whatever it is. Unfortunately, most of those types of advisors don't talk or don't learn or don't care to learn about some of the risk mitigation advisors, right? So that could be life insurance, it could be annuities, it could be all those types of things that help you save your wealth in the future as you built it. Because as Warren Buffett says, number one rule of money is don't lose it. Once you make it, do not lose it. Number two rules, look at number one. And unfortunately, that's one of the things that some advisors kind of just stay focused on AUM. Then the next advisor, hopefully that's well-rounded, has a approach. I just heard of trust. Somebody say a trust name is Miki, right? Trusts are great, and how you set them up and the type of dynamics that you can do. But then within that, the insurances and what you can do with ILITs and what you can do with, tax advantage LIRPs, right? Life insurance retirement plans. If you fund these things, which is a big, big deal, if you're middle class America, lower income America, you get sold these things, unfortunately, you're probably just being sold because somebody's trying to make some money. And maybe there is a heart to it. And certainly the death benefit could be of value, but you're really not doing it for what it's actually meant to do in those purposes of tax advantages. So anyway, yeah, that's the book on sharing how money works. Stop being a sucker. I don't know if you want to share a little bit of maybe what you picked up from it. I know you're in the journey of getting your licenses. It's been great. I've sent out about 47 books now, another 5 today with Shateka and Casey and the other room that we had the other day. So my pleasure. And it's just a gift. I think all of us, we work with Heartland Institute, which is a non-for-profit educational financial education firm with our group. And I think all of us, like Shateka, myself, or whoever's licensed in this industry, instead of fighting each other, instead of trying to say, well, my product's better than your product, or I'm selling this product because it's better than yours, or whatever, it'd be nice that all of us join forces and actually really educate. Because guess what? There's been a big problem in our industry as the most dominant industry, the most wealthy industry in the world by 2 of real estate and retail, and yet we can't get our act together to educate America and the world of how money works. So that's just my 2 cents. Thank you, Shateka, for the space here. Thank you, Euro. I think you might have picked me in. My daughter was playing with my phone, and all of a sudden in my earpiece, I saw that I got in. So here, if I can add any value, certainly looking forward to working with anybody that wants to talk offline and just share ideas. Take care.
Oh yeah, thank you. It's Shateka, if I may just
Yes.
comment on what John said.
John. I just want to say, I don't know how far you are in terms of staying in the room, but I did want to thank you for bringing all that value that you just dropped. You just dropped a whole lot of jewels, and I'm definitely interested in knowing more about your books. I just followed you on Instagram and everything, so I'll check you out soon as well.
Thank you so much. So, John, I want to show everyone on stage, right? So, I got this book not too long ago from John, right? And he's a man of his word. He sent the book. I got it, right? But I was so busy, right? When I had the book, and one of my mentees, a young man, I'm like, educating him because he wants to take his securities industry essential exam, right? So I'm teaching him some stuff. So I was finishing up some other books, and I was like, well, you know what? I have it sitting here, and I'm like, I'm gonna get to it. It looks interesting. I read, skimmed through it, and then he's like, hey, bro, if I could borrow it for a day, I'll bring it right back. And I'm like, all right, yeah, sure, right? And so he comes back and he's like, wow. He makes, certain notes and he's like, wow. He's like, Euro, this book is amazing. And it's very simple to understand, but it's very powerful. And I think it's the perfect book for someone to read when they want to understand these concepts that they're going to come across, right? And so I wanted to speak on this one section, right? Where my friend, who I let him borrow the book, right? And he came back to me and he said, Euro, there's this part in the book, right? And this blew my mind. I said, oh my God, I never even looked at it like this, right? He said, there's a part in the book, and John knows, page 53, a solution to one of society's greatest financial blunders, right? It says, one of the greatest financial blunders of society is dismissing the first 2 decades of a child's life as nothing more than a giant expense to parents. Like, just that perspective alone, guys, like when he pointed that out to me, it blew my mind because I was like, yo, you know what? That's totally true. How when people have children, they look at it like, oh, here's another expense. Other than looking at it like let's turn your child's early years, that is quote the book, by transforming the child's early years into earning years, right? And it said, why because you want to leverage the power of compound interest. So I mean, like, this says you could leave a $1 million inheritance. You could set aside $13,000 at birth, right? I mean, so many different things, but just even looking at it that way, right? If we didn't know any other specifics on money and things like that, right? Just to be able to look at it at that perspective of saying, wow, why am I looking at my child's first two decades as an expense other than a way to be, use them as tax advantage and build something so that they don't have to worry about anything. And then it says, the sucker who won't even have enough money for their own retirement hopes in vain to leave their children a small inheritance. So it's kind of like, wow, I'm seeing that a lot. And I'm like, some people, they don't even have their retirements together. And then they have children, so they can only pass on what they know. Right, so just that one perspective I wanted to speak on in a book that, John, I'm pretty sure he'll be able to send you guys. He would love to. Like, just look at it like as that from that perspective of, hey, I have a child, and why, and not to look at that child's first 2 decades as, oh, it's an expense, we're going to have babies and this, but look at that as a way to actually build something for them. Look at how these children can have these tax advantages. Like, I know if you have a child, and they're of a certain age, right? You have a certain business. Let's say we have a business. We can pay our children $12,500 a year tax free. Like, do we ever think about those things like that, or like to get that life insurance policy, as you say, Shateka, on that child at an early age, so by the time they do turn 18, they have cash value and something that they could apply. So just in case that child doesn't want to go to college, you can say, all right, well, you're 18, you're gonna about to be an adult, even though you're still young. You can take this money here in your life insurance policy. You actually, and then you have an idea, right? Because if you don't want to go to college, I would make my child have an idea, a business idea, right? And I say, all right, here we're gonna try this out. We're gonna take this money that I've been building up for you for the past 18 years, right? And you're gonna use that to finance your own business. And we did it through a tax advantageous vehicle such as life insurance, right? Or the 529 college savings plan, right? And then, I mean, it's a beautiful thing. So I just wanted to speak on that, John, because I am going through the book, right? And so I said that one section right there, not that that's the only section, but that one blew my mind. Well, I said, wow, just look at it as at a different perspective. How many people look at their children as an expense rather than earning potential for that child to leave them with something in their lives that they'll be able to take and do whatever they need to do with. So I love that. So I mean, the book is invaluable. So I want to thank you so much, John, personally, give you personal testimony that I got the book and I'm reading it and I'm learning every day. So I'm Euro and I'm done speaking.
Awesome. Great stuff. All good stuff. I like the part about children and how you can look at them differently, and not as an expense, but literally as a way to start literally preparing for their retirement or your retirement, even more so, depending on what age you have your child at. I mean, you could actually start compounding and really helping them to win in life. Like literally, if they wanted to have a business in the future, if you started at my policy, when they graduate high school, some of them may not want to go to college. I mean, let them choose, and if they want to choose to become a business owner, they can do just that with the money that you've already started. So that money can go towards their business instead of their education, because today people are not doing traditional education like they used to, right? So there's so many multimillionaires and billionaires that never even had any type of degree. To be honest, it's really about the person's discipline. So when we talk about retirement, all types of insurance and how to leverage for retirement, definitely want to deep dive into that content as well. So let's talk about that. We talked a little bit about term and how that really can't help us for retirement. So I think that we're all on the same page there. Now, not to bash term policies by no means, because I do believe that, you have to start with where you are. It is for some people because that's what they can afford, and that's fine if that's where they are. Sometimes people supplement their other policies with terms because they want to have $1 million in coverage, right? And they may not be able to afford that in a whole life, or they may not be able to afford that in a IUL, right? So they decided they want to supplement that with a term policy. That's fine, right? But at the end of the day, we know that term is really a donation, and only 2% of term policies actually get paid out, unfortunately. So we have to take a look at that closer. Like, it's not really getting paid out. You're going to outlive that term policy, and so that's something that we have to really take a closer look at, right? So when we think about positioning ourselves for retirement, we know that there's actually a policy out there right now that will guarantee you $3 for every dollar that you put in, depending on the fact that you are at least a six-figure earner, or you are in a six-figure combined household income, or you have good health. Those are basically the qualifications, or I should say prerequisites to getting that type of a policy. But I like to talk about that for like the catch-up plan for the person that's like behind and just looking for something that can help them catch up in their funds because they just haven't done a great job at saving for retirement. That's definitely out there, and that's actually in my profile as well. But I think it's very attractive for the individual that's looking to retire sooner than later. Any other comments out there around types of insurance that you're possibly using or have heard of or want to discuss in terms of how to leverage a policy for retirement?
So if I could jump in, if you don't mind.
So, absolutely.
One thing to think about, depending if you're in your 30s, 40s, 50s, if you could fund these things, since the specific topic is all types of insurance and how to leverage for retirement. I think Euro was shared earlier, the ability to loan yourself that money, right, and having to pay it back, that principle. But actually, just to clarify it, go a little bit deeper, most companies have what's called a wash loan, basically function to it. So just to give an example, right, Shantae, Mickey, Sean, all of us, everybody in below, Jennifer, Nikki, Shaniqua, you start building something, right, and the cash value grows. And what happens is most of these companies have what's called a wash loan based on FIFO. So if you write that down, first in, first out. If you think about it this way, if you have value at your home, it's called an equity loan, right? The home equity loan. Any type of loan is not able to be taxed, and that's one of the advantages, one of the reasons that you can do stuff like this. And hopefully I won't go too far and making it complex, but basically when you get to a point where you have some significant money, and this is how you start to use it as a retirement vehicle, let's say you have 400,000 or I got a call there. And basically you are able to take out first in was the money that you put in pre-tax dollars. So that's money you have to take out because that's the money that you already paid taxes. You've funded the policy and you move into a situation where you start to borrow off of that money. And that is not a loan. But when you get to the point where you now are using the money that you accrued based off of earning interest in that cash value, Now it's called a withdrawal loan. So, and what happens is you get a loan that's not taxable. If your cash value, as an example, just to make it simple, you have $1 million, you're drawing out 4%, that's 40 grand a year, tax free. But because the principal is $1 million, you take out 40, now you have 960,000. But technically, if you're making that interest in the cash value, 4%, you're getting paid back, right? And then on top of it, it washes the interest that they're charging you for the loan itself. So again, it's called a wash loan. A lot of people just don't understand that piece of the puzzle. I'm actually jumping on at 10 o'clock. Sorry, I'm a little late to some, but hopefully that brings value to someone just to kind of share with you guys, but I think too, the $1 million baby concept, Euro, for sure. $1 million baby, we could all change the next generation. I'll just leave you with that because I have to jump on a call, but we could literally all change the next generation. I have a 9, 7, and almost 2-year-old. Every single one of them, I put $2,000 into this cash value policy. And for the first 4 years, I'm going to put about $160 in it in each one of them. By the time they're 4 or 5 years old, I'm pretty much going to stop. And by the time they're 65, if they just earn 8% interest on average, okay, they will be millionaires, every single one of them. And they will, from their father and mother, they will have inherited a policy that will be tax-free in the future. And with taxes going up, that's the thing I'll share with you too. Nobody talks about taxes. Nobody talks about, we just printed more than 40% of the money that was ever printed in the United States has been printed last year and this year. Printed, meaning we have flooded the market with US dollars, fiat currency, and somebody has to pay for that. And that's called taxes. So, whatever your political view is, doesn't matter to me. But, these politicians all they're going to do is start to tax people more and more and more and more and more because somebody has to pay for it. None of this money is free. None of it, just comes from nowhere. So set yourself up today, yesterday, tomorrow with things that are tax advantaged so that in the future, as those monies grow, you can have the ability to withdraw tax-free. So that's my 2 cents. I am out. I may stay on stage here, but I have to jump on a Zoom here. Sorry, guys. So if there's any questions, DM me, or I can answer maybe a little bit in the future.
Okay. Thank you, John. The bomb, though, you got to jump on and appreciate the information. Definitely, we know that you can actually start a policy on a child as early as, after 14 days after they're here, right? So that's definitely what we're encouraging people to do. If they have a child, basically they can do that, right? And that's not to be looked at as an expense, but as an investment. So I love that perception or that paradigm shift that you're giving people out there around how we need to look at children, not as an expense, but as literally an opportunity to be able to make more money, basically, for them as well as ourselves as a parent, right? I'm not a parent yet, but yeah, I mean, it's definitely a different view. So policies is one way that the wealthy stay wealthy and they pass it down from generation to generation, because 14 days after that child is born, they have a policy slapped on them, and it's definitely going to be making them a millionaire. And that's what you call them, the millionaire baby. If you do it right, you can just do the math and do the illustration, and it'll show you how much you can put in every month or every year to determine whether or not they're going to be that when they graduate high school. Some are doing other things, but policies is definitely one of the ways. So let's talk about these paradigms around, retirement. People are looking at the old style of retirement. There's a new style of retirement, and it includes just what we're talking about at the beginning, how we can, leverage policies to not have to pay so many taxes, but to really become the bank of our money, to be the lender and not the borrower. And just really doing wealth differently. Before we used to have that mindset of, buy term and invest the rest, and nobody knew how to invest the rest, and they would lose their money investing and things like that. But now we know that there's other ways around that, and it's including an IUL policy, which actually will allow you to stack up cash value, right? To be able to take that loan out that we talked about that's not taxable. Loan is not taxable in a cash value that you pull out, policy. And so that's the reason why people are able to get around the taxes, and especially small business owners. Small business owners are leveraging life policies with a key man or a buy and sell agreement, a key man insurance policy. and they're basically becoming the lender of their own money, right? So they don't have to go to a loan or a bank. They don't have to go to a bank to try to pull out money to fund their businesses. Just like Walt Disney and J.C. Penney and so many others. They're just becoming the bank of their money and taking that money out and letting it work for them in their business alone, right? So it's just a smart thing to do for anybody that's looking to scale their business, but don't want to have to take out all these expensive loans at that to have to pay back. So there's a lot of ways that you can leverage that, and that's how they're retiring. They're retiring from their own businesses, right? Because they have money built up in that business so that they can, be able to do that. Now, as a business owner, you're paying less taxes than a W-2 employee all day long. And if someone would have told me that years ago, I wouldn't have stayed in the, in corporate as long as I did. But that's how they're doing that. So the average person now works for 7 different companies during their career anyway. And so the 401k is being replaced, right? Is being replaced by the insurance policy. The IRA is being replaced by the insurance policy. Why? Because the insurance policy is being there is no taxes. When you take out a loan for the cash value, or if you just want to just allow the death benefit to play itself out, if you wanted to do that. But there's just too many sophisticated ways to be able to leverage a policy outside of those government programs that are out there. That's definitely taxed. Other comments out there?
I love it, Shateka. I don't have any comment. I'm just like listening and learning, and I love it because it's so it's these certain type of insurance policies. I've been hearing people speak about the different things they can utilize them for, and and the retirement part is something that I didn't know about. So I'm just like listening and learning. But I'm here with you. I'm loving everything you're saying.
Yeah, so when we think about retirement, we're thinking about self-funded. And how are you going to self-fund? You're going to self-fund in some type of policy. And there's the types. Now we can get into the content of what types. So you got the whole life policy, right? And that's definitely a guaranteed death benefit that you're going to have. Or you can have the index universal life policy, that's not so guaranteed death benefit, but is a cash accumulating cow. I mean, it is the best of the best when it comes to accumulating cash in a policy. Is the index universal life policy. And you will hear some talking about, okay, well, there's still costs associated with that, and so it's not as attractive to them. Well, as a trade-off, you get a whole lot more cash value built up, but you may have to pay some expenses, right? So pay some cost to that. And so you just need to know what they are. I don't believe that the costs, by no means outweigh the cash value that's being built up in those policies when you look at it. If you did an illustration, the amount of cost associated with that type of insurance policy is, to me, minuscule, for what people are discussing. And of course, the older you get, the cost rises as well. So that's something to understand. However, if you max fund those policies in its earlier years, ideally the first 10 years of it, right? You definitely can kind of ride that out and let it do what it do in terms of baking and making more cash value for the most part, right? But it's really about understanding not only what the illustration says, but the offer. That's something I want to talk about. Most people see the illustration, but the illustration does not have all the costs. So when you think about costs, the index universal life policy has a little more cost than whole life. There's some whole life policies out there that don't have much cost at all. And they also pay dividends, right? So if you think about, well, if I got to self-fund my retirement, I definitely want the most money that I can make in a policy. So you have those, what we call participating companies, carriers, right? Those participating carriers are going to pay you dividends on top of the cash value. So that's the type of policy you really want to get into if you're looking to really self-fund your retirement. And so that's something I want you to be aware of. I know Penn Mutual has a pretty attractive one out there, and there's some others out there. That's the first one that comes to mind, right? But they definitely allow you to really max. So literally, you can put a certain amount of money in, say, a whole life policy, let it sit and let it bake and let it do what it do. You don't have to worry about losing money to cost. So that's what some people, that's more attractive to some people. Others, they want to just really see that cash value build up as quickly as possible over their lifetime. And then they may do a 1035 exchange, right? So they might move it from that type of policy, which is index universal life policy, and they might move that into, say, a whole life policy because they already have enough cash value to do what they need it done for whatever reason, rather it be weddings for the children, a new house, whatever the case may be. And then they 1035 exchange that over into a different style of policy. That's just another whole sophisticated way of getting the cash value and moving on to something that's more secure in terms of not having to pay so many expenses as it relates to those types of policies. But the goal is really just to see, what your goal is, right, in retirement. Like we started off the conversation, so we know with 20 years left after 65, if that's the age you decide to retire, what does your lifestyle look like? Is it going to be one where you downgrade, upgrade, or stay the same? And if it is, then you just multiply what it is that you're receiving in your income every year times 20 years, and then that's what you need to have when you retire if you don't want to work another day in your life, right? So that's the math on that. But one of the ways that we do that is through bulk, financing or max funding these policies as much as possible. And the one that builds the most cash value, that anybody will let you know that knows policies, is going to be an index universal life policy. And that is the reason why they want to do that, right? But if you want to have security and want to have a guaranteed death benefit, that's not the route to go. You got to go to a whole life or what's called a GUL type policy. So just understanding those types from a death benefit perspective. The other thing I want to talk about is, he mentioned earlier about health savings accounts and things like that. You actually have that built into your policy. So you have where, if you get chronically, terminally, or critically ill or chronically injured, instead of you having to, dig into your retirement account, because that's when most people have their challenges in their health is in their latter years, you can actually use your policy to be able to, pay off some of those medical bills, right? So if you have heart attack, stroke, dementia, Alzheimer's, anything of that nature, if you lose, 2 of your 6 active daily living activities, right? So if you can't use the restroom, whatever case may be, you get to accelerate your death benefit and use those funds to do whatever needs to be done in terms of, your health care, whether it be long-term health care or, facility care or whatever the case may be. You don't have to go broke and go into bankruptcy like so many people do in retirement because they fell on some medical challenges, unfortunately, that they did not, factor into, the latter years of their life. So that's the beautiful thing about those types of policies over any type of term policy, because term will not give you those living benefits that the other policies give you, in addition to the cash value that's going to build up in those policies. Any comments there? Y'all a quiet bunch, or y'all multitasking, one of the two. So
no, I'm listening to you, Shateka. Yeah, that's real. Yeah, that's what in my studies I learned that too. I was like, oh wow, so that's what the accelerated death benefit. So and I mean that is something that people should know, right? And I love these rooms, and I feel like we have is when these rooms is so I'm like it's the quality over quantity, right? And I'm like so many people they really need this information and education, because a lot of people you'll talk to them and say, hey, life insurance, and the first thing that I'm sure pops into their mind is term life, like I might outlive that, or it's no good. Once have that permanent life insurance policy designed correctly, it's kind of like, hey, because a lot of people feel like you got to die in order for them to transfer that wealth, that money or whatever tax free. But it's literally like if you fall under those things, permanent, chronically ill, like you can tap into that, into that cash and you can use that essentially. So that's something that I believe is very valuable for people to actually understand, So I'm listening as well.
Perfect. So yeah, Nikki, you had something? Or Nita?
No, I just want to say I'm listening. I'm working, but I'm listening, and I love this discussion. I'm done.
Absolutely. And Nita, welcome to the stage. And Shaniqua, if you guys have anything.
I'm actually, Shateka, in the midst of something else in business, but of course, I'm always trying to be in the room to be able to hear and work at the same time. So I always appreciate the value you have in your rooms.
Thank you, Nita. Well, all right, guys. Well, I really want to get on here and kind of talk a little bit about some of these retirement tips and what we can do to make sure that we are positioned, in terms of moving in the right direction towards retirement. So many people want to move into retirement, but they don't know how. They don't understand the steps that it takes to do that. I often, mention, the 6 steps to financial freedom, and the reason why is because the reason why most people don't retire is because, of course, they're not financially free, first of all, and second of all, of course, they don't have the income. So one of the ways there's 6 ways that you can actually move into financial freedom, and I just kind of wanted to speak to some of those because it's super important to understand that so that you could move in the right direction sooner than later. And the first one is going to be cash flow, right? So making sure that you can earn some additional income. That is a big concern for most people, is having that cash flow. And so there's so many sophisticated ways that you can do that. You can literally, if you have your money in the right items, you could actually invest and just live off the interest. I've been doing that with some investments, and I had no choice. I had to move from corporate to being a full-time entrepreneur, and so at the end of the day, I had to make the right steps, right? I had to put my money in the right vehicles in order to be able to do that. And like I told you, if you're not doing that, if you're not putting your money in something that's going to make you at least 20% or so, or 10 to 20 at the very least, you definitely are not going to keep up with inflation, for one, and you're going to be losing money in your accounts by just keeping it in a bank account. So want to make sure that you are having some type of way to allow your money to make money for you while you see. When you think about CEO, you creating employment opportunities is what CEO stands for, but you need to be the CEO of your money. So create some employment opportunities for your money where your money's making money for you, right? So that's the number one thing, cash flow, and making sure that you have some income coming in. There's too many ways out here today to make money while you're sleeping, right? Too many ways, right? You think about trading, and you think about being someone that has some courses online. You develop it once, boom, and you put some systems in place and processes in place, and people buy your products. You're making money, right? This is a lot of ways to be innovative and creative today. There's no reason for you not to have an additional stream of income, right? And so number 2 is the emergency fund, making sure that you have 3 to 6 months of income stacked away. But I would say even more so if you're looking to take that leap from corporate into a small business ownership, I would say at least have a year, because so many things that's happening, in businesses right now. And just making sure that you have that money saved up for unexpected expenses. Number 3 would be, of course, debt management, making sure that not only you consolidate debt, which is putting a Band-Aid on it, which is actually very expensive. If you hire anybody to help you get out of debt, you're going to pay about 50% more over the debt that you already have. So you don't want to do that. You want to eliminate the debt. How do you eliminate the debt? Like what I said, number 1, making sure you have streams of income, and that you're making your money make money for you. And then the money that your money makes, you're going to move that into debt elimination and not debt consolidation. And so a lot of people are doing that with policies. We actually have a certain type of policy that can tell you exactly when you're going to be financially free based on the interest that you're paying on your student loans, based on the interest that you're paying on your IRS debt, your mortgage, whatever you have. It'll tell you when you're going to be financially free because it knows the interest rate that you're paying. And most people don't even know the interest rate that they're paying, as we mentioned earlier. So definitely want you to know that. Number 4 will be, of course, proper protection, making sure that you protect against your loss of income. Let's say your spouse, expires. Do you have a plan in place, right, to be able to make sure that you make up for that loss of income, right? Or even if you have to lose your job, there's IULs out there that's basically having a loss of employment rider. A rider is any type of additional benefit that you can get, added to your policy, and you can get a loss of employment rider to certain policies where if you lose your job, that's a loss of income. Well, it's protected because you have the right policy up against that. Number 5 would be building your wealth, right? So outpacing inflation, like we talked about earlier, and making sure that you reduce your taxes. If you are doing anything for retirement that is not including some type of life policy, you're probably going to be paying taxes in the future, most likely, right? So even if you have a Roth IRA, there's still some taxes you have to pay up front. But if you do a policy, you don't have to pay taxes at all, right? Because anything that you take out is a loan, which is not taxable, according to IRS Code 7702. Okay. And then number 6, finally, is, of course, the same thing, still reducing your taxes, but also building a family legacy and making sure that you have a trust in place. Most people don't have the trust. And unfortunately, things don't happen the way they should. All right. And there's some taxes. There's some tax. And I'm not a CPA by no means, or any type of tax attorney or anything of that nature. So let me be clear about that. But you do need to see an estate attorney to make sure that you have a good trust that's tax friendly towards your retirement, right? In place. If you don't have that, definitely encourage you to do that. You can get trust start anywhere from $600 to about $2,500 to do, depending on the sophistication of what it is that you're trying to do in terms of the trust. But definitely encourage you to do that. So those are really my 6 steps towards financial freedom, if you will. And of course, there's 5 more to go with that. But I usually, for the sake of these rooms, I only keep it to those 6 to really get you a proper foundation. Because if you can get that proper foundation going, you'll be financially free, and that's going to move you closer towards moving that needle to retirement, right? So that's what we're talking about today. Different types of policies. I didn't get into a whole lot of policies today. We just kind of talked about some IULs, and we talked about whole life policies and why and how to use both of those. All right. And there's others out there, but the goal is to really just make sure that you have a policy that you can see. I would encourage you, if you don't have one, to make sure that you get a couple illustrations, but just to understand that if you have those illustrations, that they do not show you the cost that is associated with having those policies. So you want to see the offer to understand the cost. The cost is never in the illustration that any insurance provider is going to give you. You want to see what the cost is, and that will only come with an offer. So be really clear about that. All right. Any questions out there before I wrap it up? Because I didn't want to be long. I wanted to be strong. We started at about 10:20, and it's 11:25 Eastern Standard Time. We'll be back here on Thursday nights at 8 p.m. Eastern Standard Time, as well as next Monday at 11 a.m. Eastern Standard Time. So we're going to start doing these on Mondays and Fridays, but next Friday I'm traveling, so we won't do it next Friday, but we'll do it next Monday and then Thursday night at 8 p.m. So definitely, if you're not following the Winning in Wealth Club at the top there, definitely want you to follow this club, and you get all the pings and when we're in there, or even follow myself. I do have a free retirement planning workbook, right? So it's a free retirement planning guide you can download from my link collection, Shateka.com, or you can go to my Instagram on my link, and then you can see where it says you can download my retirement planning workbook. So go ahead and do that if you like. Definitely my gift to you for staying to the end. And I look forward to collaborating more with you all. Any questions, any final and closing comments? I'll start with Euro and go around the room.
Oh, yeah, sure. All right. So, Shateka, I love it. And I had no idea this. I'm actually writing a book called The Algorithm of Wealth, right? And so before we close the room, I just want to read off what my definition of wealth is, right? Sorry, I got my washing machine in the background. I believe this is my definition of wealth. Like, wealth is when process is inevitable. Through the use of properly structured corporate entities in combination with intricate financial models, wealth is born. Wealth is not a net worth amount, but rather equated by how much one can limit loss and transfer their profits into financial vehicles that produce compound interest. And I think that kind of sums up, what my definition of wealth is. And I believe that, I personally believe that wealth starts with that permanent life insurance policy, to just build that foundation of protection and to increase that interest that we're in, become the person that's collecting that interest. So I'm Euro, and I'm done speaking.
Awesome, Shantae. I'm gonna tell you my definition of wealth at the end.
So I just believe that wealth has nothing to do with money. Money is just a tool and a resource to get us the things that we need here on earth. So we need it, right? We need money to do the things in the earth, but wealth has nothing to do with money. Wealth has everything to do with your ability to keep your sanity, your ability to think properly, and to be able to live in the 7 principles of life in a healthy way. When you have a healthy, balanced life, that you can be free and not subject in any form. When I say slavery, I mean slavery to addictions, slavery to other people, slavery to a system, slavery, so wealth is being free and not subject to a system or a way or others. Um, and even in your finances, being free, being liberated, being able to be debt free and not being subject to debt. So that's my definition of wealth.
I absolutely agree with that, and I appreciate you bringing that value as well. John the Bomb.
Hey, I'm back. Thank you for allowing me to stay there. Yeah, look, I think Shantae just kind of nailed it, right? It's not money. It's not, it's really everything, right? An abundance of valuable possessions or a valuable mindset, a valuable family, right? My 5Fs are faith, family, finance, fitness, and fun. So when I have abundance in all those 5 areas, then I feel pretty wealthy, right? And sometimes there's imbalance. I don't think there is a whole, perfection of balance in life. I don't think we tackled some of that, but that's kind of my definition of wealth is having abundance and especially that mindset, right? Of, my mom came from some wealth in her background of her life when growing up. But in Colombia, and for the level that they had. And then she came to America and cleaned toilets when she first got to Chicago in a hotel at the Marriott. And unfortunately, I think she always had abundance in the sense of, she had me, her only child, and in Spanish she would say I was her hijo preferido. What that means is favorite child, but if you understand that I'm an only child, that's the only child. So she would always say it. But my point of saying, like, where she came from wealth and then came to America and unfortunately never built that type of monetary wealth. She always had abundance in her spirit. She was a dancer. She loved music. She loved talking to people. At her wake, instead of crying, instead of being sad, we had, we're not Mexican, but she loved mariachis. I had mariachis come to her wake. And we partied at her wake. We didn't have a somber sorrow, I guess, I don't know the words, but to let her go to the afterlife. So I think there was abundance in that, right? And knowing that she had affected a lot of people in her own way, it wasn't monetarily. One of my abundance mindsets and goals, big audacious goal, is to now form a school in Colombia that will be endowed with a trust that will pay for up to 25 kids every year to have education and financial literacy in South America, Colombia. So I've got a lot of work to do to be able to do that, but that's kind of one of my abundance mindsets. So again, wealth, abundance, and the way that you think, the way that you have money, the way that you give back, the way that all that stuff. So hopefully that helps someone. I'm John the Bomb. Building others means business, and I'm out.
I love it. Building others means business. Sean.
Oh my goodness. I have so little to contribute. When I see the quality of people on this call, it's just absolutely fascinating. An amazing group of people with so many good ideas and such motivation. I'm just floored. I started last night with you, and just very, very refreshing.
Thank you, Sean. Shaniqua.
Hello, thank you, Shateka, and to those that went before me. My God, did you guys add so much value? And I appreciate all of your input. And I am very much, Shantae hit the nail on the head. For me, wealth starts with health. And when you really understand health lies in everything. Health lies in your body, health lies in your mind, health lies in your finances, health lies in your relationships. So health is required to establish wealth. And I live by the principles of GFB. GFB, yes, God, family, and then business, and placing things in the right priority in the right order. I believe that we're not here to chase purpose, we are purpose. And when we understand exactly who we are, then we're able to define what it is that we're supposed to do so that we can become. And oftentimes we are so busy doing, we don't never become what we're established to be, so that we don't attract the wrong things. I believe that there is definitely a law of attraction. And when we understand that law and we stay in the established order of what we're supposed to do, there's an attraction to things that come along to us. My favorite scripture is when I really think about it, it's in Ezra 10 and 4. You never really hear many people preach it, but it literally says, rise up, the matter is in your hands, we will support you, so take courage and do it. And oftentimes it's the courage in doing the right thing, even when people don't understand what you're supposed to do, that leads to unhealthy processes within yourself that leads you to operating your life in disparity instead of certainty. And we should be certain about who we are, certain about what we're doing, certain about why we're doing
it. All right, Mark. All right, mic drop. Nikki. All right, so we are rounding it up, everybody. Thank you for joining the room. We actually are at the end of this room. Appreciate you for coming in. We'll be back on Monday at 11 instead of 10. And so we'll do that at 11 o'clock on Mondays, and not this Friday coming up, but the following Friday. We're also here on Thursday nights at 8 p.m. Eastern Standard Time. So if you're not following the Winning in Wealth Club, definitely want you to follow the club. Definitely looking for some more moderators to moderate some rooms in this club as well. So if you're interested in moderating, please send me an email so that you can, be a part of this and start moderating some rooms, because I'm not the sum of us is greater than the one of us. One of my CEOs back in the day said, and I just took that to heart. I am definitely one that look for collaboration. I would look for collaboration over competition all day long. So if we can partner, we can win. And so you all have said so much around wealth. There really isn't anything to add. I mean, my little definition is really simply the glossary definition, which is an abundance of valuable possessions of money when it comes to wealth, right? I just have an acronym for it, and I spell it out as the W for wealth, meaning wise. Most people that have wealth are people of wisdom. Solomon was the wisest and richest man that ever lived. E stands for entrepreneurs. These people are not scared to take risks. They're risk takers, right? They're not scared to let their money make money for them. And then, of course, the A is for and then L is leaders. The leader, they bring solutions to solve problems, and that's how they can build wealth through the monetary aspect of it. Of course, we understand it's your health, it's your relationships, it's your everything, right? But they're leaders. In other words, they're the highest paid people usually out there, rather be in a career or on their own business. But they bring solutions and they solve problems. The T stands for transformation, right? So it's they're transforming. They have to grow and develop to become the person that they need to be in order for their business to follow suit, to be prosperous, right? And so the H is for history. They're history makers. They usually down new trails. They're trailblazers. They make a difference in the lives of others in a different way. And that's how they're able to be wealth builders. So that's pretty much my definition for wealth and my acronym for wealth. And anybody else have something else to say before we go ahead and end this room? This is your last and final call. Well, all right. Thank you again. I will see you on Monday at 11 a.m. or Thursday at 8 p.m. If there's no other comments, thank you for joining me. And I'll see you at the top because you belong there. God bless you.